Welcome back everyone. In this section we have discussed about all the options Greeks. Now you must be wondering how to calculate all the Greeks for an option. Actually we need not to calculate options Greeks because many of today's trading platforms provide all the Greeks values for different strikes. But you can also calculate these values yourself by using options calculator which uses Black-Scholes options formula. The Black-Scholes options pricing calculator is based on Black-Scholes options pricing model, which was first published by Fisher-Black, Maron-Scholes, and Robert Merton. We will not go through the maths involved in Black-Scholes formula because it's very complicated and you need not to know about it. But we will briefly understand it. Just think of Black-Scholes calculator as a box which takes in some input and generate some outputs. The inputs required are market data for an option and outputs will be the options premium and options Greeks. We need 6 inputs variable for this calculator, that is spot price, that is the current market price of the stock, strike price, that is the price of your options that you are buying or selling, time to expiration date, that is the current expiry for which you are trading the option, dividend, this is the dividend payout that the company is paying till the expiration date, but if company is not paying any dividend then you can keep the input as 0. Risk-free interest rate that you can find below the options chain and implied volatility that is different for different option and you can see the value from options chain. Then if we fill all the values in Black-Scholes calculator then we will get all these outputs in which we will get call and put premium value, delta, gamma, theta, vega and rho. Let's take an example to understand it. This is the 5-minute chart of Siemens and you can see the stock is trading at 1419 level. So this is the options chain of Siemens. The current expiry is 27th of February. And if we want to calculate the options Greeks for 1420 put strike, then we will see this data. This is puts data. So you can use Black-Scholes formula and you can find online any Black-Scholes calculator, but I'm using Zerodha calculator. So in this calculator, we will fill the spot price of the stock, that is the current price, and the current price of the stock is 1420. We will fill this value here. And suppose we want to know about the Greeks of 1420 put strike. So our strike will be 1420. We are trading the ATM strike, same strike, and the expiration date is 27th of February and volatility is for this strike. See, this is implied volatility and 1420 put strike have IV as 37.44. So we will fill this value here. Interest rate is 10, that you can see below the options chain. See, this is 10% interest rate and this is the risk-free interest rate. So this is 10%, and if we calculate the options Greeks for this put options, so these are the options Greek. This is delta, this is gamma, this is theta and rho and vega. So these are the options Greek and these are call and put premium for this current strike. Suppose if we want to trade this stock for options trading, the stock was in my momentum scanner and we are trading the stock for day trading perspective. So you can see the stock is trading near the support level and it was a sharp down move in the stock, and you can see RSI is trading in oversold range. So here we can sell the put option of this stock. See, this is the sideways movement in the stock on hourly chart and this was the support level. That's why we can sell the put option of this stock for intraday perspective, and the level is 1399. So we can sell the put option of 1400 strike. So 1400 strike is trading at 28.10 rupees. This is the bid price of put option because we are selling this put option. And I always suggest not to sell the naked options. That's why we will employ a stop loss order slightly below this support level. So if we want to employ our stop loss level at 1386 level, so this is our stop loss on price chart, but we can also calculate our options price with respect to this stop loss level on price chart with the help of Black-Scholes formula. For this, we will simply change the spot price to 1386 in this calculator, and we are selling the put option of 1420. So we will fill 1400 as our strike price, and the IV for 1400 put strike is 35.81. We will change this value. So our stop loss level should be 44.51. So if we are selling the put option of Siemens, we will employ our stop loss level at 44.51. But this value is with respect to this IV. In options chain, currently IV is this. It changes regularly. That's why this stop loss level will be valid for intraday trading only. And in this way, we can also calculate our target level with respect to price chart. Suppose our target level is the upper band of this Bollinger Band. We are expecting that prices will consolidate here near this level within the range of Bollinger Band. So our target level is 1445 rupees. And this is the level on price chart. So we will calculate our options value with respect to this level. So we will simply fill the value in spot price 1445, and our target is 20.62. So this is our target price for our options. We are selling the put option. So if our price will reach at 20.62 or near this level, then our position will be squared out here. In this way, we can calculate our stop loss level and target level with respect to these price levels. Welcome back everyone. Now you can see Siemens is trading very near to our target level, and it is $29 profit in this stock, but we have sold the put option of 1400 strike. So if we see the current price of 1400 strike, see this is the current options chain, and the 1400 put strike is trading at 22 rupees. Our target level was 20.62 rupees. So we will wait for some time, because if we see a consolidation within this Bollinger Band, still our premium will decrease for our put options, though prices are very near to our target level. Now see, the put option premium is 20.70 and it is very close to our target level. So here we can close our position. So in this way, we can adopt our stop loss level and target level with respect to our price chart. For example, these are the levels on price chart, but with the help of these levels, we have calculated the levels for our options in which we have sold the put option of Siemens, and this was the live trade. So in this trade, we have sold the put option of 1400 strike at 28 rupees. And now we will buy the put option. So we will see the ask price of 1400 strike, and the current price of this put option is 20.70. So this was a very good profit in this stock. The lot size for Siemens is 550. So the profit from options chain is 8 rupees, and if we multiply with this quantity, so it is approximately 4000 rupees profit in this stock within 1 hour. So in this way, we can calculate our stop loss and target level for our option. But those levels will be applicable for intraday only, because implied volatility regularly changes and those levels are according to that IV. So next day, if we are trading for positional trading, we have to calculate the levels regularly based on different IVs of that strike, and we have to change the stop loss and target level regularly if we are trading for positional trading. But for intraday trading, obviously we can calculate these levels with the help of Black-Scholes calculator. Thanks for watching. See you in the next lecture.